You have recently been appointed in the credit department of Standard Bank. One of your main tasks is to do credit evaluations on the loan applications made by small and medium enterprises. The decision to grant credit to these institutions is based on their financial position and their financial performance as set out in their annual financial statements. Currently, you are looking at the financial statements of Stapledon Pty Limited. It is a medium-sized enterprise with an annual turnover of 60 million rand and a net profit percentage of 15%. What is net profit percentage? That is my net profit, so income less all expenses, divided by sales. Okay. Stapledon has never made losses in the 10 years of being in business, but they have experienced serious cash flow problems in the last financial year, ended on 31 December 2016. Financial year end. The financial director approached the bank for a bridging loan to overcome what he called the short-term liquidity crisis. Upon close investigation, you have obtained the following information. Number one, the format used to present the financial statements is not the same than the usual format used according to international financial reporting standards. It seems as if many line items have been grouped together and only one figure is shown on the face of the relevant statement to reflect items such as other assets, other liabilities, sundry operating income, and sundry operating expenses. Now guys, if you think back about the characteristics of financial statements, underneath that we saw aggregation and materiality. So make sure that you understand what aggregation and materiality means, because here it is clearly both of those. Aggregation is when they group a lot of things together, and materiality is well, it all depends how material the figures are that we're going to group together. But if many line items have been grouped together, then they must probably in contradiction with the rules of aggregations and materiality. The financial director, Mr. Staples, informed you that the statements are not 100% correct. Well, you know that that is one of free from error. So it's not free from error because it's not 100% correct. Then it goes on and it explains to you, it says equipment to the value of 1.5 million rand was accidentally shown as inventory. Guys, so it was shown as a current asset. What should it have been shown as? As a non-current asset. You only discovered it after the statements were given to the bank. Now, is this serious or is this not serious? Yeah, it's very serious. Why? What is inventory? A current asset. What do we do with inventory? We buy inventory, we sell inventory, and hopefully we make profits with inventory. What is equipment? Equipment I use in my, let's say we are a manufacturer or whatever, or if I'm not even a manufacturer, I use my equipment in order to generate income. But what should I allocate to my income statement what non-current assets are concerned? I'm supposed to depreciate the equipment over its estimated economic lifetime. So here is huge problems. If I'm going to work out my liquidity ratios, what do? I take current assets and current liabilities. Suddenly I have a huge current asset. So it looks as if my working capital position is very favorable. So current assets less current liabilities equals working capital. And if I take my current assets as a ratio to current liabilities, if I have a 2-to-1 ratio, it means that I'm fairly liquid and I will be able to cover my short-term or to reach my short-term commitments, repay my short-term commitments. So if I suddenly have a huge asset there, obviously it's going to have a huge impact on my liquidity ratios incorrectly. What does this guy do? This guy goes to the bank. He wants a loan from the bank. If the bank, obviously, what is the bank going to do when it consider giving this guy a loan? He's going to look at the financial statements and he is going to decide whether this guy will be able to repay the loan commitments on the short-term and the long-term basis. But if he's not liquid enough, if there is not enough cash available, he will not be able to repay his loan commitments. And if I'm now going to juggle around with my liquidity position and change it to a vastly favorable ratio, obviously it's going to mislead the bank. The bank is going to think that they will have more than enough cash resources to pay them back. Where, meantime, back at the ranch, that is not a current asset. That is not an asset that's going to be traded. This is an asset that's fixed of nature and it's going to lie in the books and it's only going to be depreciated. So there's no income that we're going to receive from the 1.5 million rand. Yeah, we're going to use the equipment in order to generate income. But inventory is something that we have cost of sales, and that is the cost price of the inventory that was sold, hopefully at a higher price. So this is a very, very serious mistake that was done in the financial statements. Comparative figures are not shown. Now, we know that that is one of the enhancing qualitative characteristics, that we need comparative figures. Why? If I have nothing to compare something to, how on earth do I know whether it's good or bad? I cannot compare the company's own or the entity's own figures with that of previous years. How do I know that they perform better? How did I know they perform worse? How did I know that they are continuing on the right path? How do I know anything? I don't know anything. So comparative figures are very, very important. Then number 5, it seems as if the 2016 financial statements are not completely finalized. Again, financial statements should be complete and free from error. It's not free from error and it's not complete either. So what does it actually, what contribution can it make to any kind of decision that any user of those financial statements are going to make? Zero. Nothing whatsoever. So it's useless. Number 6, you came across an article in the Financial Times that implicates Stapledon in a lawsuit. After you asked the financial director what it was all about, he denied any future financial loss as a result of the lawsuit. Apparently, a client took the company to court claiming their product was faulty. It caught fire and caused serious injuries to the client. The claim against the company is 1.3 million rand. Guys, do you think it's a material claim? Yeah, obviously it is. It is a small entity, it's a medium entity, has a 60 million rand turnover, that's sales. But it only has a net profit percentage of 15% of 60 million. So 1.3 million is going to have a serious impact in its future profitability. And they just ignored to keep quiet about that. This was the only incident of this nature reported, and the financial director assured you that the quality control procedures are of the highest standards and no losses will be suffered. This is the reason why no mention of the lawsuit was made in the financial statements. Guys, I don't care whether this financial director is a good guy or a bad guy. I don't care whether he's talking rubbish or whether he's not talking rubbish. One thing I do care about that he is definitely not clairvoyant and can see into the future. If there was one claim of 1.3 million rand because their product caught fire, remember the old Kugas, who says there's not going to be a series of claims that is going to be instituted against the entity because their products obviously there was a problem with that specific product? Who says there are not more of these? So although I don't know what amount to pass in my financial statements, the very least I can do is to write a note where I mention this fact to the users and then let the user make up his mind himself. What kind of risk is involved here? So what is required from you? Write a memo once more to the financial director of Stapledon in which you provide, explain, and apply the fundamental qualitative and the enhancing qualitative characteristics set out in the conceptual framework of the International Financial Reporting Standards based on the information submitted to the bank. Good. So I mean, the 6 things that they've mentioned here is a clear indication what you should be talking about. So somewhere, if you know the theory, remember the way that you're going to answer a question, firstly, you're going to jot down the theory. And then for each and every point that you mention, which is theory statement, you have to apply that to your circumstances in the scenario given to you. So I will start again with a memo to Mr. Staples from Credit Manager, 10 April 2017, subject financial statements. Dear Mr. Staples. And then you're going to start with what is the purpose of the financial statements, because that is what the characteristics are all about. That is to make sure that the quality of the financial statements will be as such that the users can rely on that and make decisions based on the information that was supplied to them. So the purpose of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors. To achieve this, financial reports must have certain qualitative characteristics which increases the usefulness of the information provided in the financial reports. And then you're going to start with the fundamental qualitative characteristics, and I must say they are relevance and faithful representation. Under relevance, you're going to say relevant information is useful and have the ability to influence the economic decisions of users, the theory, helping them to evaluate the past, the present, and future events. The characteristics have one or both the characteristics of a predictive value or a confirmatory value. The nature and materiality of the information can influence the decisions of the user. Still, theory, faithful representation is ensured by completeness, neutrality, and free from error. Completeness is ensured when all information needed by the users is disclosed. Omissions can be misleading if it is material and does not ensure faithful representation. Okay, let's talk about these things by referring back to the scenario given to you. Not disclosing the lawsuit against the company is misleading. As the amount is material, the fact of legal action should be disclosed to keep the user informed of possible future financial implications. Neutrality, we say, is ensured when information is not presented in such a manner that a predetermined result is achieved. Non-disclosure, again, of the lawsuit indicates management is biased and only considers information that would be favorable to their position. Disclosure of the equipment as a current asset inventory further indicates management is not neutral in their disclosure, as a position of liquidity is created to aid their credit application. Free from error does not necessarily mean that information is 100% correct, but it means that the description of the event and/or transaction is free from error. Faithful representation is not achieved by grouping a lot of items together. The user of the information cannot understand, nor can he interpret the line items for what it is. The actual error occurred when non-current assets were understated by that 1.5 million, that equipment figure, and current assets were overstated by 1.5 million. This amount is material and certainly will mislead the users. The enhancing qualitative characteristics are comparability. Users must be given comparable information that enables them to identify trends over time. That is the purpose of comparability. Now, in our scenario, comparative figures were not always given. General accounting practice should be applied to make comparison between entities possible, and this is made difficult by the company as normal accounting standards are also not followed. So it's not only that they don't present comparative figures, it's also exacerbated by the fact that they don't follow the rules and regulations set out by the accounting financial reporting standards. So there's no way that I can compare this entity, well, not even to himself, but what to say with other similar kind of entities. And then verifiability enables the users to confirm that presented information faithfully represent the events or transactions it purports to present. The information discloses inventory results in unverifiability and does not present an actual transaction or event incurred by the entity. Another enhancing characteristic, timeliness. All the information, the older financial information gets, the less useful it becomes. So at the end of March, this guy has not even finalized the December 2016 financial statements. And he has the audacity to take this half-baked product to the bank and request a loan. So we say the financial statements have not been finalized. The usefulness of that statements, over and above the fact that there are mistakes and omissions in, is also negatively affected because it's not timely. Financial statements also failed the completeness test. Understandability, next one, financial statements should be understandable to the average user who has a reasonable knowledge of the business and is willing to study the information diligently. The group disclosure of various items result in information that cannot be clearly understood and properly be interpreted by the users and can be misleading. And then just to close off, I trust you will amend your statements to adhere to the above principles and resubmit your loan application. And you can say yours sincerely, a student, whatever, credit manager. Guys, it is not to say that your answer will be word for word what we have said here. But somewhere in your answer, I would like to see the purpose of financial reporting. Somewhere in your answer, I need to see relevance and the description of relevance. I need to see faithful representation and the description of what is faithful representation, where you're going to discuss completeness, neutrality, and free from error. And somewhere in your answer, you need to apply whatever you've said there to the information in this scenario. So obviously, for every valid remark that you've passed, you're going to receive a half a mark. So you must let yourself lead. You must look at the mark allocation of each and every question, and that should lead you to how many points you should raise in your question, in your answer. Because the general rule is for every valid statement that you make, you will get half a mark. So if you look at relevance, for instance, you will get a half a mark just for mentioning relevance. And then when you go and explain it to you, for that you would have received a half mark. For that you would have received a half mark there. Yeah, you would have received a full mark, one for predictor value, one for confirmatory value. And the nature and materiality, probably another mark. Completeness, neutrality, and free from error, and faithful representation. Just to mention that, half a mark, half a mark, half a mark. And then for every valid point that you raise under each and every one of them, another half a mark. So neutrality, there we've done what it is and the scenario. Free from error, what it is and the scenario. Enhancing comparability, verifiability, timeliness and understandability, each one of them would have been counted to half mark. And then when you've told me what comparability is, a half mark. When you have applied that for every valid point, a half mark. So potentially you can see that you will also get marks for your layout. So the fact that you're writing a memo and the fact that you are also then ending the memo properly. So you see that potentially in a conceptual framework question, you can earn a lot of marks. The danger is that you write too much. The danger is that you write too little. So that's why I'm saying look at the number of marks that the question is counting. And then you can judge more or less how much you have to write in order to make up all the marks.